Topic 7, companies. In this topic, we're going to split our work into two sections: the general taxing of companies and the particular rules that apply to a company, and then franking accounts. I'll start off just talking normally about companies, and then we'll go and look at the franking accounts in a minute. Much of what we're going to look at today in relation to the taxing of companies is the fact that a company is a separate legal entity from its shareholders. So you'll find when we look at bad debts and losses that because of this differentiation between the company and the shareholders, certain rules had to be applied, because otherwise the tax rules might have been manipulated in favour of the taxpayer. A couple of things to be aware of: companies have a flat rate of tax of 30%. So whether they earn $1 or $1 million, it's 30%. There's no tax-free threshold. There's no incremental increase in the tax rates. Remember that we talked about in topic 1 the pay-as-you-go instalments. Companies are also subject to these instalments, and this is important when we look at franking accounts a bit later. So the same rules apply, and I will give you the company tax instalments paid. The definition of a company: we're going to look at the definition, public versus private, and then special rules which apply. A company is defined as a body corporate, any unincorporated associational body of persons that does not include a partnership or non-entity joint venture. So the first thing that's important is the difference between a public and a private company. And in this part of our course, we'll just keep it very, very simple, and also bear in mind that the tax definition isn't the corporations law definition. And there's a reason for this difference. We have a lot of companies in Australia. People use them mainly because of the limited liability. But one of the things, they're used significantly by husband and wife businesses or family businesses. And it's because of this that a lot of the rules apply, and why we need to be aware of the difference between a public and a private company. If you think about a public company as having many shareholders who may well hold the directors to account if something isn't done properly or done in favour of a few people, with a private company, if you just have mum and dad as the shareholders who are also the two directors, or maybe even just one of them who's the director, decisions can be made to benefit the family which may compromise their tax liability. So, of course, as a family, they're trying to pay as little tax as possible. And because no one else is holding them liable and saying, well, you can't lend money to that person and then write off the debt, we have to have specific sections of the Act which come in and protect the revenue. So that's why you have this difference between what is a public and what is a private company. And the sections we're looking at apply to private companies. Now, I love the definition because it says in 103A(1), so we're still looking at the 1936 Act, it says a company is a private company if it is not a public company. So it's a great definition. So basically, you're one or the other. So what we need to do is look at the definition of a public company. And a public company is one in which the fixed shares are listed on the stock exchange on the last day of the year of income. So if your shares are listed as at 30th of June, then it's a public company. If it's a public company, some of the rules we're going to look at won't apply. They only apply to private companies. If a company is listed on the stock exchange, the Commissioner has the ability to apply the 2075 rule and still consider the company to be a private company. And the rule is that if 20 or fewer people can control 75% or more of the shares in the company, then it can be held to be a private company. You do see this situation arise where you have a family business which is quite successful but needs additional capital to expand. So they'll float the company on the stock exchange, but the family might keep 80% of the shares, and the family might be, say, two brothers and their wives, which is actually a situation I had to deal with once. And then the other 20% were held by members of the public. Now, under the 2075 rule, because 4 people controlled 80% of the company, even though the company was listed on the stock exchange, it was held to be a private company. Now, the Commissioner has got the discretion to not apply that rule. So the Commissioner might look at who else owned the other 20%, and perhaps if it was a large superannuation fund and these people wouldn't want to do things to upset them, the Commissioner might say, look, I'll let it run and treat it as a public company. Right, so what are the implications of being a private company? The first one concerns loans and payments to associated persons. So who is an associated person? Husband, wife, mother, father, child, brother, sister, associated companies, associated trusts, and so on. We look now at section 109, and basically it says that section 109 says if a private company, pays or credits an amount to an associated person which is excessive for what is done, then so much of the amount that is excessive is treated as a dividend. Now, it has no impact really on the person receiving the excessive payment. The implication is to the company, because the company loses some of the tax deduction, because a dividend is simply a distribution of profits. It's not an expense of the company. So actually it's a point worth making, because often students try and deduct a dividend as an expense. You have the income, the expenses, the taxable income, you pay your tax, and out of what's left, the way you get that profit to your shareholders is by way of a dividend. So a dividend is not an expense incurred in earning the income of the company. It's a payment of the profits to the shareholders. So with the company, if they paid an associated person $200,000 and the Commissioner said, no, only $100,000 is reasonable, then instead of the company being able to deduct wages of $200,000, it can only deduct $100,000. So its profit goes up by $100,000. The associated person receiving that now receives a salary of $100,000 and a dividend of $100,000. So they're still paying tax on $200,000. The effect is on the company, not on the associated person. You can imagine, of course, in a company situation where someone who might be getting dividends but might be up on top tax rates might instead say, we'll pay a salary to an associated person and thereby use their tax-free threshold and 15% tax rate. This section will still tax them, but the company loses the deduction. I've got an example for you. The private company pays $50,000 to the managing director's spouse for working in the business 2 days a week. The Commissioner considers that $10,000 is reasonable, so we increase the income of the company by $40,000, and the spouse now shows dividend $40,000, salary $10,000. Under Division 7A, there are rules that now apply to loans and amounts paid on behalf of shareholders and associated people. And again, if it's a loan, it's not income of the person receiving it, but this section deems it to be a dividend. Now, there are rules which apply, and the rules say things like if you're going to make a loan, then it has to be in writing, there has to be interest charged, there has to be a repayment schedule, and if you do all those things, then it is a loan. If you don't do those things, then it's a deemed dividend, and the dividend is restricted to the distributable surplus of the company. Now, we don't really take it much further than that. You can have a little read about that in your Master Tax Guide. The next rule that applies only to private companies here is, for our purposes, is in relation to carry forward losses. The reason this section was incorporated into the Act was years before, when we didn't have it. What used to happen was you'd have your company and it's got a loss in it. It's got, let's keep it simple, two shareholders, A and B. This company's running at a big loss. Now, C and D happen to own a business that's very profitable and it's going to pay a lot of tax. So, and remember, we're looking pre-capital gains tax days. What they would do is C and D would simply buy A and B's shares. Then they would transfer that business into the company. They would be able to offset the losses of the company against their profits and pay much less tax. They would pay A and B a sum of money for the shares, so A and B would be happy. They've got something out of their loss-making company. The Commissioner, of course, loses tax because of the use of the carry-forward losses. So this section says you cannot, a company, and it's very specific, a company cannot deduct carry-forward losses if it doesn't meet one of two tests. The first test is the continuity of ownership test, and the second test is the same business test. The continuity of ownership test says that the same people must have owned the same shares from the loss year all the way through to the income year in which they're trying to recoup the loss. So basically, if A and B and C own shares and then there's a loss made and then we're trying to recoup the loss a couple of years later. Now, maybe C's decided, well, you know, I've had enough. I'm going to sell my shares to D, or I might sell a few more of my shares to A or whatever. You have to meet the continuity of ownership through that whole period. If you think about the logic behind it, what they're saying is if you were the person who bore the loss as a shareholder, then you should be the person who gets the benefit of the loss when you start to make a profit, not someone who's just come in and taken it over. If you fail the continuity of ownership test, which you'll often see written as COT, continuity of ownership test, then you fall back into the same business test. And this test says that you, from the time the ownership changed, so from when you breached your 50% rule through to when you're claiming your loss, the company must have carried on the same business. Now, this is where, what they're saying here is, well, if you've come in and taken over this loss-making business and you improve it, and now you should be able to bear the loss. You should be able to benefit from the loss, rather. But if you come in and you completely change the nature of the business, so you come in and you say, well, this was a retail business and we're going to stop doing retail and move to wholesale, then you can't benefit from the loss, because the loss is not coming from the loss year and now making things, helping things along when the profits are made. The profits are made from something completely different. The same rule applies to bad debts. If you want to write off bad debts that were income in an earlier year, then you must meet continuity of ownership or same business test. So in the answers, you often see COT met or SBT met. Now, if your continuity of ownership test is met, you don't need to even look at the same business test. So, for example, if A, B and C owned the shares, the company is making a loss, and then A, B and C get together and say, look, this isn't working, let's finish this business and start this new business, then because the continuity of ownership test is met, the company can still carry forward and offset that loss. But if C pulled out and A and B might have had 50 and now they've still got 50, but D's got the other 50. They don't have more than 50. So then we look at the same business test. They don't pass the same business test, so the loss is lost. So you would want to think very carefully about changing ownership or radically changing the business if you want to use those carry forward losses. And this is where you might want to think about if you knew that you were going to change ownership, you may well want to up trading stock valuations to use up your loss, as much of your loss as possible. I've given you some examples in here so you can see the changing of the shares and the fact that the tests are met or not met. Now we come to the second part of companies, and that is the franking account. We also call this dividend imputation. I discussed this briefly with you in topic 1, but now's the time to look at it in more detail. The classic method of taxing dividends used to be that the company paid tax on its profit, then paid the after-tax profit to the shareholders, and then the shareholders paid tax on that income again. And as I explained to you in topic 1, when this used to apply, a lot of the income, up to about 78%, was going in taxes and only 22% was passing through to the shareholder. So it made it very unattractive to invest in a company because so much went off in tax. So what we now have is the situation in which the company pays tax on the dividend. So remember I said $100 profit, $30 tax being the 30% tax rate, $70 after tax income. That goes as cash dividend to a shareholder, and the shareholder is imputed, is credited, is deemed to have also paid that tax, that $30, so that's part of their income. So the shareholder's income, cash 70, franking credits 30, $100, pay the tax, but the shareholder gets the credit of the $30 tax paid by the company. And as I said to you in topic 1, if the shareholder's only paying tax at 15%, they can get a refund, or they can pass the credits on, use the credits against other income. If they're on 30%, the dividend is tax-free, and if they're on 40 or 45, then they're only paying 10 or 15% tax on the dividend. So what we have to do now in the franking account is we have to work out how many franking credits a company has to be able to attach them to a dividend. Now, if they always made a profit of $100, we'd be easily able to say, oh, it's $30 and that's what we can attach to the dividend. But of course, it's not that simple. So what companies do, is they keep a franking account. Now, a franking account is a different account to what you're used to, because what you think would be a credit is a debit and vice versa. So what I'd like you to do at this point is write in big letters in your notes, a franking account records the tax paid by the company. It records the tax paid by the company. Now, because it's recording tax paid, every time tax is paid, the balance in the account goes up. And every time that tax that it's paid, it gives it to its shareholders attached to a dividend, that's a debit in the account. So people have a little bit of trouble with this because you tend to think that paying tax is a debit, but it's not. In this account, it's a credit because we are recording the tax paid by the company. Now, the account works on the basis of debits and credits. Remember, it's recording the tax paid by the company. So each time the company pays tax by way of an instalment, by way of the balancing up tax at the end of the year, that's a credit. If it receives a franked dividend from another company, remember that other company has paid tax, has attached some of that tax to its dividend. So when that dividend comes through to our shareholder company, those franking credits are also a credit. So anything to do with the payment of tax is a credit in the account. And every time those credits are reduced in some way, that is a debit. Now, the franking account, as far as we take it, is really very, very simple. We have 3 credits, I think 4 debits that we're looking at. And that's it. If it's not in that table, it's not a debit and it's not a credit. So what we're going to do is each time, so the first credit is when the company pays tax. So each time under the instalment system, the company lodges its first tax return, the Commissioner now knows how much tax it needs to pay and sends it a quarterly notice saying, pay this percentage of your income for the quarter. So each quarter the company pays an instalment. I will give you that figure. The first thing, a company can only use franking if it's a resident company, but we are only going to look at resident companies, so that won't be an issue that you will have to decide. As I say, the account records debits and credits, and the account is recording basically the tax paid by the company. So the first credit is each time the company pays a pay-as-you-go instalment. So on the date that the payment is made, there will be a credit entry in the franking account. And then there's a balance kept. So you might start with 0, you've paid an instalment in July, now your credit's gone up. I've given you on this, and you might like to print it out and try and do it yourself, I've recorded everything in there. And to start with, it's probably a bit difficult because we're going to talk about different credit entries. And of course, in reality, as you make a payment, you update your franking account. Then you'll receive a franked dividend. You'll make a record in your franking account. Here, it's a little bit mixed up because I'm going to tell you about instalments and then you can put them in. But what you might like to do is wait for all my explanations, and then, knowing the explanations, you can go back and fill in the franking account for yourself. So if the company pays a pay-as-you-go instalment of $25,000 on the 28th of October, that is going to be a credit entry on that date. So when you come to the 28th of October, you make the payment to the tax office and then you record it as a credit entry. You then up your balance from the previous balance. If you subsequently pay instalments on the 20th of $20,000 on the 28th of February, 15 on the 28th of April, then they will also be franking credits. The second credit is where the company pays income tax. This might be the first time they pay income tax. Small companies who pay less than $8,000 a year only pay income tax once. They don't have to pay instalments. Or at the end of the year when they balance up, they find they've still got a little bit more tax to pay. So when they pay tax, that's another credit entry. Remember, it's a credit because our account records the tax payable by the company. So it pays tax, it goes up. It pays an instalment, it goes up. Again, it's the date on which the payment is made. So if the company lodged its tax return on the 1st of March, $5,000, that's the credit on that date. Now, if a franked dividend is received by the company, the franking credits are credits in the franking account because the franking credits are tax paid by the other company and they're being passed down to our shareholder company. So it's just the credits, it's not the cash dividend. And again here I've got a couple of dividends, one's fully franked, one's partially franked, and it's only the franking credits that need to go in. The last one is the franking deficit tax, which will be a credit on the 30th of June, and that will make more sense to you in a minute. So that's our 4 credits. I think I said it ran the other way. Now, franking debits are when the tax paid by the company is reduced in some way. So the first one is where the company attaches those franking credits to a dividend. That is a franking debit, and it reduces the balance in the account, because what we're doing is we're recording how much tax the company's paid, and now we're saying, well, we're giving some of that tax to the shareholder along with the dividend. So that's a debit in the franking account. And if we said it was a $700 dividend that was franked to 100%, then the $300 is the debit in the franking account. So, and it's on the date that the dividend is paid. And again, we've got another one here where it's $105,000 dividend franked to 100%. So we have a debit entry of $45,000 on the 1st of June. The next debit is where the company receives a refund of income tax. So maybe the 4 instalments that they paid were too high, and they get a refund. Well, each time they made an instalment, the balance in the account went up. Now they're getting some of that back, so it's a debit. So, and it's just the amount of the refund. And the last one is a franking debit, where the entity franks a distribution in contravention of the benchmark rule. And I'll be explaining that to you in a minute. Okay. So those are our 3 debits and 4 credits. So I've given you a couple of examples here where they pay some dividends, and you can see that you've got debits and credits now in your franking account. So the franking account is actually pretty simple, because you've got set debits and set credits. Just a word of advice, please set out neatly one of the papers I've just marked. Because the person got more and more messy, in the end, all the debits were in the credit column, and he added them, because they're credits, he added them instead of taking them off, and just lost about half the marks in the franking account. So what a lot of my students do is they actually draw up 3 columns and write debit, credit and balance, and so everything goes in the right spot. Now, having done all that, which is really pretty simple, what is the implication, what is the impact of all that? And this is the impact. Depending on the credits it's got available, the company can decide to attach some of those credits to the dividends that it's going to pay its shareholders. The first thing is, it can't pay more tax than the underlying tax on the dividend. So if the profit was 100, the tax was 30, the dividend was 70, when they pay that $70 dividend, the company can never attach more than $30 to that dividend. So that's the maximum amount they can actually credit on that dividend. So with a $70 dividend, you can't say, well, we've given you $35 credit. They can only ever give $30 credit. That's the maximum. Now, again, with private companies, they can be manipulated, particularly if you've got different classes of shares. Now, what you could do, if one class was taxable Australian shareholders, one was non-taxable Australian shareholders, and one was overseas shareholders, what you might want to do is give all your franking credits to your taxable Australian shareholders, because they get the most benefit out of it. Non-taxable shareholders, well, they don't care. They're not paying tax. And overseas shareholders don't care, because if they live in a treaty country, they might only be taxed at 15%. So they don't really care about the franking or otherwise of the dividend. So if you had a lot of cash to pay, but not enough franking credits to frank them equally, So when you go to pay your taxable Australian shareholders, if you try and give them all your franking credits, the benchmark rule says that you have to give the same percentage of franking credits to your subsequent dividends during the year. So what they're saying is if you fully frank the dividend to the taxable Australian shareholders, you must fully frank your dividends to the other two categories of shareholders. This ensures maximum tax collection for the tax office. So what we know is if we frank the first dividend to 100%, all subsequent dividends must be franked to 100%. If we frank the first dividend to 50%, we can't then frank the second dividend to 100%. We've breached the rule. And if we taxed it at if we franked it to 50%, we can't frank the third dividend to 30% because we say, oh, we haven't got enough credits. We got our calculations wrong. So that's what the benchmark rule is all about. Whatever percentage you allocate to the first dividend of the year, you must allocate to all subsequent dividends. Then the next year, you can change your percentage again. So the question is, how do we work out how many credits to attach to a dividend? The first thing we do is we must work out the maximum franking credits. What is the most amount of credits we can attach to this dividend? So remember our $100, $30 and $70 example. If we want to pay $70, what is the maximum we can pay in credits? And the formula is you multiply that, the cash dividend, by the company tax rate over 100 minus the company tax rate. So that is, so you're going to multiply the dividend of 70 by 30, the company tax rate, over 100 minus 30, which is 70. The two 70s cross each other out and you're left with $30. And $30 was the tax paid on the $100 profit. So that's the first thing you do. So what's the maximum we can give? Then you say, well, maybe the maximum is $30, but you've only got 20 in your account, in your franking account. So then if you said, well, I'll give $20, then that is the percentage to which you franked your first dividend. So it's the franking credits allocated, 20, over the maximum franking credit, 30. So you franked it to 66.67%. Now, subsequently, you have to frank all your dividends for the year to that same percentage. If suddenly, if you thought, oh, I did that because I didn't have many franking credits, now you've paid a few instalments, you've received some franked dividends, you think, gosh, I've got all these credits. Oh, I'll fully frank the next dividend. You can't. You've breached your rule. So we've got this example here where on the 1st of August the company pays a dividend of $1,000. Now they had a previous dividend that they franked to 100%. It must also frank this dividend to 100%. If it only franks it to $200, then it's breached its franking rule. So the first thing we have to do is say, well, what is the maximum franking credit? And that's 1,000 by 30 over 70, $429. Because we've only attached $200 of credit, we've only franked it to 46.62. Because we franked our first dividend to 100%, we've breached our rule by 53.88. Now here, we've underfranked, and that's going to be our underfranking in our franking account. So that's $229. And what you wouldn't want to underfrank a dividend, because what happens is you just lose those franking credits and your shareholders would be really unhappy because $229 has just gone as a debit and it's just disappeared out of your account, out of your franking account. So if you breach the franking rule and you underfrank, it's a franking debit. If you get that in a question, you would show the actual credits and then the underfranking as two separate entities in your franking account. So how do we frank? And if you overfrank, so the first dividend was 50%, you frank the second dividend to 100%, you've breached your franking rule, your benchmark rule by 50 percentage points, you go through the whole thing again. But overfranking is a penalty tax and it's payable directly to the tax office. There is no credit for it in your franking account. Look at the debits and credits we've done. There is no entry for overfranking. It's simply a penalty tax paid to the tax office. So how do we frank a distribution? We allocate a credit to it under 205-40. The maximum credit is the profits underlying it. We use our formula in 202-60. So it's the distribution paid, the dividend paid multiplied by 30 over 70. And we're going to set our rate now. So if we look at the example, if the company makes a distribution of 80,000 on the 1st of July and 20,000 of credits, then the franking percentage is as follows. The maximum credit, the maximum franking credit is 80 times 30 over 70, 80,000 by 30 over 70 to give us 34,286. However, we've only allocated 20,000, so 20,000 over 34 by 100. We've only franked it to 58.33. And therefore, we've breached our benchmark rule. If we breach, we pay overfranking tax or a franking debit equal to the shortfall. And the percentage is the franking percentage differential from the first dividend multiplied by 30 over 70. Now, the example I've given you here is we franked our first dividend to 58.33. We subsequently pay another dividend and tax it frank it at 40%. We pay a third dividend and frank it to 60%. You'll see here we have a franking debit of 3,142, and we have an overfranking tax of $214.71. The 3,142 is a franking debit. The $214.71 is overfranking tax, which is payable directly to the tax office. It is not a franking credit. The fact that we have a benchmark rule ensures that companies don't breach it. It's like a penalty provision that's in there, and because it's there, you would just frank each dividend to the same percentage. Of course, in our exams, because I'm trying to see if you understand the legislation, I will usually put in an underfranked or an overfranked dividend. But the reality is, because you've got that provision there, most companies will do the right thing and frank all dividends to the same amount. Now, while a company can go into debit or deficit during the year, because perhaps it wants to pay a dividend at the beginning of the year and fully frank it, knowing as the year goes on it will have more credits coming in, that's not a problem. It can spend the year in deficit as long as it finishes the year in credit, and that credit becomes next year's opening balance. But if, let's say, the company gets it wrong, pays out too many credits, and finishes the year in deficit, then it must pay franking deficit tax. And the Act says the franking deficit tax is due as you are aware that it's in deficit, and you wouldn't know that till the 30th of June. Well, you might know it beforehand, but basically in case something was coming in on the last day or whatever. So on the 30th of June, you're really deemed, so as soon as it's gone into deficit at that point, you actually pay the franking deficit tax, which is the amount of the deficit. Now that is a credit, so you go from a debit into a credit position. In fact, you go to zero. Okay, so that's another credit in our account. So now you can calculate, You can maintain a franking account for a company using these basic debits and credits. As a result of knowing the balance in the franking account, you can now work out by how much you wish to frank a dividend. You can't frank to more than 100%. You can certainly frank to less if you want to, and the benchmark rule ensures that you don't breach that first franking percentage. Remember, the under-franking is a debit, over-franking is a penalty paid directly to the tax office. That takes us to the end of companies. We've looked at the specific rules that apply to companies, and we've also looked at the maintenance of a franking account.